Hi, thank you so much for stopping by. Now tell me, is it possible that you may be unknowingly overpaying the Canada Revenue Agency or the CRA thousands each year? It might sound hard to believe, but thousands of Canadians are doing just that. But there are others who are paying half the taxes that you are paying legally. These strategies are not hidden, but they're in plain sight, and most people completely miss them. Now, this video is not about avoiding or evading taxes. That's illegal. But you can actually reduce your taxes. These are tax saving strategies that are allowed by the Canada Revenue Agency. So, if you're serious about keeping more of your hard-earned money this year and even into next year, you are watching the right video, because I'm sharing 6 secret strategies that could help you pay less taxes legally. Now let's jump right in. As a financial educator, I have spent many hours liaising with clients, and these are the top 6 legal ways that you can pay less tax. This video is for information purpose and has been presented in a very simplistic way with very simple examples. So please, if your tax involves complex topics like multiple rental property or estate tax or any income splitting other than RRSP, speak to a CPA. Okay, number 1 is understand how you are taxed. I've heard many people say that they are afraid of being promoted or getting a pay raise because they are worried that it will bump them into a higher tax bracket, leading to more taxes and less money for themselves. This is one of the biggest misconceptions that people have regarding taxes. In Canada, we have a progressive tax system with marginal tax rates. So basically, the higher your income, the higher your tax rate will be. But this higher tax rate doesn't apply to your entire income. Now, let me explain. For example, if you're earning $75,000 in Ontario, you'll fall into the average federal tax rate of 20.5% tax bracket. But that doesn't mean that your entire $75,000 is going to be taxed at 20.5%. The way to understand this is to imagine each tax bracket as its own tax account. As you earn income, you fill up each tax account one by one until you eventually run out of income to fill up an entire tax account. Now, the first tax account represents the first tax bracket, and all the income you put inside this tax bracket is taxed at 15%. When it comes to the second bracket, you're taxed at 20.5%. So, when you're earning $75,000, to calculate the federal tax on $75,000, you will be paying $8,003.85 for the income in the first bracket of $53,359. And for the remaining $21,640, which of course is your $75,000 minus your $53,359, you will pay 20.5% of $21,641, which is $4,438 and about 40 cents. So your total federal tax is equal to $8,033.85 plus $4,438.40, which is $12,442.25. But note that this amount is just the federal taxes, and it is before you claim any tax deduction or tax credits, which we'll talk about later in this video. One tax credit that all Canadians are eligible for is the basic personal amount. For this, our example income of $75,000, this will give you a tax break of $2,849.93. So you end up with $9,592.32 in taxes. But you might be wondering, if I'm paying my full taxes, how come I'm still getting a tax refund every year? Some people think that this is free money from the government to them, but that's actually not true. Now, here's how the tax process works. For every paycheck that you receive, your HR department has already calculated how much you're supposed to pay in taxes. And then they take that portion out of your salary to prepay the government. Now, what usually happens is that HR takes a little more than enough, just to be on the safe side, right? So when you file your taxes, you may realize that you actually paid too much to the government, and you would receive that money back in the form of a tax refund. This is the real reason why people are getting a tax refund, and you should know that it's your hard-earned money and not just free money from the government. If you're working multiple jobs, then you often run into issues where you start owing taxes instead of receiving a tax refund. This is because every employer assumes that the employee has the basic personal amount that they haven't claimed yet. So when you have two jobs, the second employer likely doesn't know about the other job and ends up taking less tax than you're supposed to pay. And you end up owing money when you file your taxes. It's incumbent upon the employee who is working a second and third job to fill in their TD1 without claiming any deductions at all. That way, the employer will be taking off tax at a higher rate, and they likely won't be owing much, if anything at all, when they do their taxes. And of course, if you have other income from maybe investments or side hustles that you do, then you're likely going to end up owing taxes if no taxes were prepaid on any of these incomes. So how can we pay less taxes then? Well, the secret is that you could have $100,000 of salary but end up with only $70,000 of taxable income by applying the tax strategies that I'm about to share with you. It's a lot easier than you think, but you do need to be strategic about it. This leads us to the second thing that you need to know about, and that is registered accounts. These accounts can be used to lower your taxable income, so you end up paying less tax and getting a bigger tax refund. There are several types of these registered accounts. First, there is the work or group RRSP, or the group retirement savings account. Now, as the name suggests, this is an account that is offered by your employer. Depending on your employer, you may or you may not have access to it. So be sure to check with yours to see if it's available. A work RRSP is where you can put money inside and you can use it to save or invest. The amount that you contribute to this account will give you a tax deduction, which lowers your taxable income by the same amount. So for example, if you have an $80,000 salary and you contribute 10% of your income into a group RRSP, this means that you contribute $8,000. This $8,000 will become a tax deduction for you, so that your taxable income will actually be lowered from $80,000 to $72,000, giving you extra tax refunds. Another way to look at this is that the funds withdrawn from a registered retirement savings plan or savings account RRSP in Canada are subject to income tax at the time of withdrawal. And there's a possibility that they could be lower depending on your income at the time of withdrawal. This is simply a choice of paying a lower tax later down the road when your tax rate is possibly lower. But that's not even the best part. The best part is that most employers offer matching when you save money into this account, meaning that for every dollar that you put in, your employer will also put in $1. This is free money from your employer. So just by putting money into this account, you're essentially doubling your money without even doing any investing. This is hands down the best account that you can use to build up your wealth. One thing to note here, though, is that because it is an RRSP, there are some rules that you need to follow when it comes to withdrawing money from this account. First of all, you can withdraw your RRSP money at any time you want, but any amount that you withdraw will become your taxable income for that year. There are two exceptions to this rule, though. Number one is if you're a first-time home buyer and you're using the funds to buy your first home. In this case, you can withdraw up to $60,000 tax-free in the year you purchase your home. The second exception is if you go back to study full-time. Now, in this case, you can withdraw up to $20,000 tax-free. However, if you withdraw your money tax-free under these two conditions, you do need to gradually refill that RRSP back up over a period of 15 or 10 years, respectively. Another type of registered account is the personal retirement savings account. This type of account works the same way as your group RRSP in terms of tax deductions and withdrawals. The only difference is that the personal RRSP are accounts that you can open with any bank or financial institution on your own, and you can have as many RRSP accounts as you want, as long as you stay within the contribution limits. The limit is 18% of your last year's income, and any unused contribution room will be carried forward indefinitely for future use. The third type of account that you could use is the FHSA, or the First Home Savings Account. This account is mainly for people to save money toward their first home, and it's only available for first-time home buyers. Now, if you're wondering if you are considered a first-time home buyer, as long as you did not live in a home that is owned by either you or your spouse or common law partner in the previous 4 calendar years, then you're considered a first-time home buyer. This also means that if you've purchased a property and have just been renting it out and never lived in it yourself, then you are also considered a first-time home buyer, and you're eligible to have this account. The FHSA works the same way as the RRSP in terms of giving you a tax deduction, but the best part about it is that there's no limit to how much you can withdraw tax-free, and there's also no need to refill this account back up after withdrawing. Another account that you should know about is the TFSA, or the tax-free savings account. Now, it doesn't exactly lower your taxable income, but it is also an important account to know about. But why you should also know about this account is because this account allows you to hold investments inside and grow them tax-free. It's also a much more flexible account compared to the RRSP or the FHSA, because you can withdraw money out from this account anytime for any purpose tax-free. This is one account that everyone should have. The Registered Education Savings Plan, or the RESP, and the Registered Disability Savings Plan, or the RDSP, are 2 other Canadian registered accounts that are investment tools that are designed to help families save for specific needs while offering tax benefits. The RESP is a savings plan to help parents and guardians to save for their children's post-secondary education. Contributions are made with after-tax dollars, but the investments grow tax-free until they are withdrawn. The government also provides additional contributions through the Canadian Education Savings Grant, or the CESG, and for eligible families, the Canadian Learning Bond, or the CLB, which boosts savings significantly. Here's the tax benefit. When the funds are eventually withdrawn to pay for education, the investment earnings and grants are taxed in the student's name. And since students typically have low incomes, they often pay little or no taxes on these withdrawals, making it a tax-efficient way to save. The Registered Disability Savings Plan, or the RDSP, is specifically for individuals with disabilities. It helps them and their families save for long-term financial security. The government adds to the savings with the Canada Disability Savings Grant, that is the CDSG, and for low-income families, the Canada Disability Savings Bond, or the CDSB. With an RDSP, contributions grow tax-free, and your withdrawals do not affect federal income-tested benefits. This plan not only ensures financial support for individuals with disabilities, but it also reduces taxes by allowing investment growth to be tax-sheltered. Both the RESP and the RDSP allow for tax-deferred growth on investments, meaning that any earnings on the contributions are not taxed as long as they stay within the plan. For RESP, when funds are eventually used for education, the tax burden shifts to the beneficiary, who often pays lower taxes. For RDSP, the tax sheltering benefits the disabled individual, who likely benefits from both lower tax rates and preserved income tested benefits. In short, RESP and RDSP both allow families to save for essential future expenses while benefiting from tax-sheltered growth, resulting in long-term tax savings and financial security. Remember, I mentioned earlier that if you're doing side hustles, then you might end up owing more taxes, but there are some tax advantages that you should know about as well. Whenever you're doing freelance or contract work, you are considered to be running a self-employed business in the government's eyes. If you're not sure if you're considered self-employed, the easiest way to tell is to see if you receive a T4 for the income that you earned. If you didn't receive any tax slips, or if you only received a T4A, then chances are you are doing independent contract work. So you're considered self-employed. Now, why it's so important to make this distinction is because there are some tax advantages, but there's also some tax disadvantages to being self-employed. Now, here's the main difference between them. Number one is any expense that can potentially help you earn more money in your business can be claimed as a business expense. This is why we sometimes hear people say that they are writing off their income because they are essentially taking their business expense and claiming it as a tax deduction. These types of expenses can include operating expenses such as advertising, meals with clients, and office expenses, as well as any equipment that you use. For example, your laptop, your camera, or even any software subscriptions that you have. And if you need to drive around for work or you need to meet with clients, you can also claim the vehicle expenses, including gas, maintenance, insurance, and even lease payments on your car for the portion that is used for your business only. For example, if you earn a $90,000 income and you have $20,000 worth of business expenses, then your taxable income will become $70,000. The second difference is home office expenses. Employees can claim home office expenses as well, as long as they have signed a T2200 form from their employer. But the list of eligible expenses is much more limited compared to someone who is self-employed. The biggest difference is that as a self-employed person, you can claim mortgage interest, you can claim property taxes and home insurance, whereas employees cannot. These are significant costs for a homeowner, and just by being self-employed and working from home, you can claim a portion of those expenses that you have used for work to write off your income. The third difference is EI premiums. For employees, EI premiums are about $1,000 for a year, but for the self-employed person, EI becomes optional. So you could basically potentially just save $1,000. But of course, not paying for EI basically means that you're giving up the maternity or sickness benefits. And the fourth difference is the CPP, or the Canada Pension Plan. As an employee, you pay 5.95% of your income as CPP, and your employer will pay another 5.95% to the government for you. But as a self-employed person, you're basically considered your own employer. So this means that you're actually paying double the amount, or 11.9% of CPP instead, both as an employer and an employee. Next is tax deductions and credits. Now, there are countless deductions and credits that are available, but here are the most commonly used ones. First is the child care expense deduction. This is for families where both spouses are working and they need to send their kid to a daycare. The lower income spouse gets to claim up to $8,000 of deduction for the expenses paid for any children under age 7, or up to $5,000 if their kid is between 7 and 16 years old. The second deduction is when you can turn your bad debt into good debt, which means that you're turning your interest that's normally not tax deductible into something that can become tax deductible. This usually requires more advanced planning or strategies like leverage investing, and it's normally used by higher income earners. For example, if someone has a $10,000 debt and they have a $10,000 investment, they can sell this investment and use the money to pay off the debt. Then they can use a personal line of credit or a home equity line of credit to take out $10,000 to put back into their investments. By doing this, they still have $10,000 of investment and they still owe $10,000, but now, instead of the original debt, they now owe $10,000 to a personal line of credit or a home equity line of credit. Now, the difference is that the interest expense that they need to pay is now tax deductible because they effectively borrowed money to invest. So now they can claim a tax deduction under carrying charges on line 22-100. I do want to point out though that this strategy is not for everyone because there are a number of factors that you need to consider, such as tax implications, investment returns, and of course the time horizon. Also, the risk tolerance and the interest rates. Some people further extend this to something called a Smith maneuver in order to make their mortgage payments become tax deductible as well. The Smith maneuver is a financial strategy used in Canada that allows homeowners to convert their mortgage interest into tax deductible interest. It takes advantage of the tax deductible interest by turning your mortgage into an investment loan. For example, let's say you have a mortgage of $300,000 and after a few years, you have paid it down to $250,000. You now have $50,000 in equity. You take out a home equity line of credit or a HELOC for that $50,000 and you invest it in the stock market. By converting your mortgage interest into tax deductible interest, you can reduce your overall tax bill. The money you invest can potentially grow over time, helping you build wealth. It's a way to potentially save money on taxes and build wealth, but it comes with risk and should be approached with caution. If you're considering it, it might be a good idea to talk to a financial advisor to see if it's right for you. Next is medical expense tax credit. Now, you can only claim medical expenses if the total exceeds 3% of your net income. For people with spouses, you can claim all the medical expenses under 1%, so this way it's easier to exceed that 3% of income. Most people just add up all the expenses that they have from January 1st to December 31st, but you don't have to use this specific period. The government actually allows you to use any 12-month period that is ending in the same tax year. So, for example, in your 2024 tax return, you could claim medical expenses from March of 2023 to March of 2024, as long as you haven't claimed the expenses in the previous tax year. When this might be useful is when there's a year where you had a lot of medical expenses, but not a lot of income. In that case, instead of wasting the medical expense and not getting any tax savings, you can save it up for the next year to see if you can get a bigger tax return. Another one is the donations tax credit. For donations, you can also combine both spouses' donations and claim it under one person. And this is beneficial because you actually get more tax savings when your donation amount total is over $200. So if your total donation amount is less than $200 in a year, then you might want to consider saving it and claiming it in a future year so that you add up to a total that's over $200. Aside from using the deductions and tax credits, there are also other ways that you can split income with your spouse or other family members. For example, you could use the childcare expense deduction that we mentioned earlier and use that to split income with your other family members. For example, you can consider asking the grandparents to help babysit, and this way you can pay them a childcare fee and then you claim it as a tax deduction. On the other hand, the family member who is helping you babysit will need to report that as part of their income. And this type of income would be considered self-employed income as well. So you could also make use of the business expense that we mentioned earlier, and depending on their income, they might also qualify for the Canada Workers Benefit. That is going to be an additional $1,400 in tax returns for you. The second way to split income is by using a spousal RRSP account. This type of RRSP account is for families where one spouse is earning significantly higher income than the other. So what happens here is the higher income spouse will use their own contribution room and they would actually contribute into a spousal RRSP account that is basically owned by the lower income spouse. Now, when you do it this way, the higher income spouse gets to use the tax deduction so it can save a lot more taxes while the money is going to stay inside an account that's under the spouse's name. This way, it will help you with future withdrawals because the future withdrawals will also become taxable income. But instead of it being under the higher income spouse's name, now the RRSP income is going to be part of the lower income spouse. So in the end, you actually reduce a lot more taxes for the family. But you might ask, what happens if the spouses split up? Well, I guess that's a risk to this method. Also, the spousal RRSP can be combined with the home buyer plan. This allows the higher income spouse to receive the deduction, and the lower income spouse will perform the repayment at their lower marginal tax rate over a period of up to 20 years. The third income splitting strategy is something called the spousal loan. This is a more advanced tax strategy that is more for higher income families. This is where the higher income spouse would basically loan money to the lower income spouse. And there will be some interest rate at the CRA prescribed rates. Then the spouse will take the funds and use it to invest. The higher income spouse needs to pay tax on the interest earned from the lower income spouse. Similar to the spousal RRSP, by doing it this way, all the future investment income will be taxed under the lower income spouse's name. Now, with this strategy, the government is quite strict, as you do need to make sure that the lower income spouse actually pays the annual interest to the higher income spouse. Otherwise, if you forget to do that in that year, then the income earned from the investment will then be attributed back to the higher income spouse. So instead of it being taxed at a lower rate, now it's going to go back to being taxed at a higher rate. As for the higher income spouse, they do need to report the annual interest as taxable income as well. If you're considering this strategy, you should consider working with a tax lawyer and also be mindful that there will be ongoing costs, such as legal fees or accounting fees, to maintain the spousal loan. This strategy is not as attractive as it used to be because it used to be 1 to 2% prescribed rate, but now it's actually up to 6%. However, it's still worth considering if you can expect to get a higher investment return compared to the prescribed rate. Also, interest rates have begun dropping, so you just might want to keep this in mind if you're in the position to take advantage of this. If you have found even one of these strategies helpful so far, please give this video a thumbs up so others can find it too. And let's keep the conversation going. Go ahead and drop a comment with your biggest tax question or any tips that you've discovered yourself. I really would love to hear from you. Now, let's talk about real estate. When it comes to real estate, a lot of people like to own multiple properties. And there's actually a good reason why they do that. It's because there are many tax benefits when you own real estate. For one, when you own a property and you live in it yourself, you do qualify for the principal residence exemption, which basically means that the home that you live in is going to be tax-free when you sell it in the future. With our home being the biggest asset that we likely will have, having it tax-free will make a huge impact on your overall wealth. Also, when it comes to paying property taxes with your principal residence, there are some provinces like BC or Ontario that offer government programs that let you defer your property taxes. So people who are eligible can actually stop paying their property taxes and pay it later with a low annual interest rate. You can defer the taxes until you eventually sell the property or when you do a refinance on the property. Different provinces have different criteria. But in BC, if you have a child that is under 18 years old or if you're 55 years old, then you qualify for this program. The idea is that you can free up the cash flow. So instead of using that money to pay the government, you can now use the money for multiple things. Yeah. You can either use it to pay for living expenses, or you can use it to build up your investment savings, or you can even contribute it into your RRSP for additional tax savings. Or if you have a child, you can use the money to contribute into their registered education savings plan or RASP to get the 20% grant from the government. I have a detailed video about RASP, which I will leave in the description below if you want to check it out. And the tax benefits don't just stop at the principal residence. when you own a property and you're renting it out, you are able to generate rental income. And usually the rental income is going to be taxable. Now, that doesn't sound too good, right? Well, listen to this. You can actually use rental expenses to offset the rental income that you make. So, for example, if you own a property and you're renting it out for like $3,000 a month, this means that in a year you earn $36,000 in total. And imagine if you had a full-time job and you add another $36,000 on top of that, that's going to be a lot of taxes. But by the directive according to the CRA, or Canada Revenue Agency, a lot of things can be claimed as a rental expense to write off your rental income. For example, you can write off your operating expenses, home insurance, property taxes, repairs, mortgage interest, and even depreciation. And because of this, now it becomes a lot more attractive, right? So let's say your rental expenses cost about 20% of the rental income that you make. So in our example, with $36,000 of rental income, your expense is going to be about $7,200. Then you can also deduct the mortgage interest, but keep in mind that you need to separate out the mortgage payment to see which part is the interest and which part is the principal, because you can only deduct the interest portion of the mortgage payments. So let's say the mortgage interest comes out to about $20,000 in a year. So that means that you can take away $7,200 and another $20,000 out from our $36,000 rental income. So in the end, we'll only have $8,800 of taxable rental income. But that's not even all. You can also claim depreciation on your furniture or appliances and even the rental property itself. And when you claim depreciation, you can actually choose how much you want to depreciate by. For example, if your rental expenses already reduce your rental income to zero, then there's probably no point for you to use additional depreciation. In that case, you can actually choose not to depreciate your property on paper and save it for future years. And you can use that to reduce your income down the road. However, there are a few nuances to this, especially when it comes to depreciating the rental property itself. While claiming depreciation does give you a lot of tax savings every year, it might also bump up your taxable income by a huge amount in the year that you sell your property. This is because there's something called a CCA recapture, or the capital cost allowance recapture. And this happens when you sell an asset for more than its own depreciated capital cost, which is the remaining value of the asset on paper after depreciation. So, for example, let's say you purchased a property for $600,000 and you sold the property 5 years later for $700,000. Then you would have a capital gain of $100,000. And since the inclusion rate for capital gains is 50%, that means that you would take $100,000 of capital gain times 50%. That will give you the taxable capital gain amount of $50,000. And this will be the amount that is going to be added into your taxable income. But let's compare what happens if you choose to claim CCA or depreciation on your rental property. Let's say you claimed $100,000 on depreciation for your property. Then the undepreciated capital cost will be $600 minus $100,000. So it will equal $500,000. Remember, we sold the property for $700,000, right? CCA recapture is limited to the amount of CCA ever taken on the property, hence the name recapture. If you sold the property for more than the original cost, the difference is still a capital gain. So in this example, there's a CCA recapture on the $100,000 of CCA taken to depreciate the property to $500,000. And there's $100,000 capital gain because you sold it for $100,000 more than the purchase price. That is $700,000 minus $600,000. You don't add the full $200,000 as recapture because there's only $100,000 of CCA to recapture in the first place. This $100,000 difference is going to be added onto your taxable income. Now, this might sound horrible. So you might be wondering, why people still choose to claim CCA? Well, there's definitely a lot of people who claim CCA because, well, they just don't know the full consequences of claiming depreciation on the rental property. All they're focusing on is probably the potential tax savings that they were going to get every single year. But this doesn't mean that the strategy is all that bad. It just requires proper calculation and planning to make sure that it's worthwhile. Because sometimes saving a chunk of taxes every year and using those tax savings to invest may actually get you a lot more ahead, even if it means that you need to pay a bigger chunk of taxes later on down the road. Generally speaking, the longer you plan to hold on to your property before selling, the more attractive claiming CCA will be, because you would have more time to invest your tax savings and try to get ahead before the CCA recapture happens. Another consideration is that claiming CCA actually takes away your ability to use the change of use elections for different capital gains. A lot of people don't know this, but if you ever decide to move back into your rental property, it is considered a change of use. And in the CRA's eyes, they would consider you to have sold the property on the day that you moved back in and repurchased the property on the same day. Now, that might not sound like much, but what it means is that when this happens, the CRA would be expecting you to pay a capital gains tax on any appreciation that has happened for your property when you haven't even sold the property yet. You simply just moved back into a property that you've been renting out, and you'll be charged capital gains tax. The way around this is to make a change of use election. But the danger of claiming CCA on your rental property is that it disqualifies you from making such elections. So to summarize, the decision to claim CCA does require thorough tax planning because it depends on how long you plan to hold the property, what your risk tolerance is, and what the investment returns that you're expecting on your investment. Now, all these tax strategies that we've talked about will not matter if you're not even getting your fundamentals right, and you keep on making some silly money mistakes that get you into trouble without even realizing it sometimes. So I want you to click here to learn about the simple money mistakes that you could be making and how you can fix them today. Thank you so much for watching. Don't forget to like, and I'll talk to you in the next one. Bye.